hour. From the budget to actual comparison, we see that Roundbelly had favorable variances relating to indirect labor, indirect materials, and other overhead costs. In addition, they had an unfavorable insurance cost, but overall had a favorable variance for the overhead costs. The problem. Okay, so let's look at the table. So we got the static budget. A static budget, as we defined up here, is a budget at a single fixed estimate of sales volume. So the single fixed estimate of sales volume was 20,000 units, right? And so we had 20,000 direct labor hours. So we had variable costs, indirect labor 80,000, indirect materials 60,000, overhead 10,000, depreciation 24,000, and insurance 4,000. Okay, so what happened is we came in at less than our estimated 20,000 direct labor hours. We came in at 16,000 direct labor hours. So what happened is, naturally, if we had less labor hours, we're going to incur less indirect labor, less indirect materials, and less overhead because those variable costs are a function of the labor hours. So we had favorable variances there. We had an unfavorable variance in terms of the total labor hours, the 4,000, because it was less than what we expected, and then we paid $100 more for insurance, but really not material. But overall, we had 23,300 favorable variance. Going back to the given information, it says the problem with a static budget is that it is impossible to determine if the variances are due to cost controls or the result of reduced direct labor hours. So we don't know if that we have these favorable variances because we had less labor hours, right? The activity was less, or because we were actually doing well in cost control. So what management does is they prepare a thing called a flexible budget. Now a flexible budget, as you see over here in 3 in this green box, flexible budgets have the cost per hour, right? Your variable cost per hour, your fixed costs. Fixed costs don't change over the different activities levels, right? Because it's fixed cost. But you have 15,000 hours, 20,000 hours, 25,000 hours. You have different activity levels, and you're saying at this activity level, what would I expect my variable cost to be, so that when you come in at a different level other than what you've budgeted, you can then determine, am I over or under on my variable cost because I was controlling costs better, or was I spending too much? Really, should I have spent less at that activity level? So Roundbelly has prepared a flexible budget using direct labor hours. At different direct labor hour volumes, Roundbelly demonstrates how they expect variable costs to flex, right? Note that fixed costs stay the same over the different labor hour volumes. Alright, let's flip this over, and we're going to go to the red number 4, which is in the top right-hand corner in the green box. And there it says, Roundbelly has prepared a flexible budget versus actual results comparison. Actual direct labor hours were 16,000. Roundbelly has prepared the flexible budget at the direct labor hours volume. Roundbelly is able to identify that they have had unfavorable variances relating to indirect labor and indirect materials. Use the static budget versus actual comparisons, they would not. Okay, using the static budget versus actual comparisons, they would not be able to identify these unfavorable variances. Okay, so we're going to take the actual information from 2 on the other side, which is the actual information at 16,000 hours, and then we're going to take the flex budget from 3, where we have those variable costs identified. So those variable costs, so we got actual hours, flexible budgeted hours at 16,000, and that's, so we got indirect labor of 64,000, indirect materials of 48,000, other overhead of 8,000. Then we have our actual at 16,000 hours, and we see that we had unfavorable variances in indirect labor, indirect materials. So what we didn't see in the static budget comparison is that we shouldn't have spent that much at that volume, right? We should have spent less. We would have expected to spend less at 16,000 hours, $4,000 for indirect labor and $3,000 for indirect materials at that volume level. And the static budget doesn't tell us that. It just shows us a favorable variance because overall the driver, which is the direct labor hours, was less. So the flexible budget is a better way for management to monitor the performance of the organization, whether it be a segment, a location, a store, product line. So that's the concept of flexible budgets. It's different activities levels versus the actual activities level versus the static budget, which is a given, a set, fixed one, and it's hard to compare that to the actual. Okay, let's go to the top left corner. The red number 5, let's do a material variance example. Alright, HMS Roundbelly has the following direct material standards for the styrofoam fill-in as life vest. 0.11 kilograms of styrofoam per vest at $10.75 per kilo. Last month, 420 kilos of fiber were purchased and used to make 4,000 life vests. The material cost of a total of $4,629. Alright, so that's our given information. So now let's put it in the formulas, and then we'll come up with what our variances are. So, we're actual quantity. We know what the actual quantity was. The actual quantity was 420 kilos. Times, and we're actually given the total cost, which is the 4,629. But what we're going to do is we're going to break it out, and we're going to actually come up with a per kilo price. That's going to help us in our variance analysis. So what we do is we take the total cost divided by the total amount purchased. So that's the 4,629 divided by the 420, and that gives us 420 kilos times $11.02. Alright, we take the $11.02, multiply that back by the 420, and that gives us the 4,629 that we were given, alright? But we want to break it out so that we can see, as we go into the other variances, we want to break it out so that we can see exactly how much per kilo we paid. Alright, so then we'll go to the middle. We got actual quantity times standard price. So the actual quantity was, again, the 420 kilos that was given, and then the standard price is also given. It's $10.75. Alright, we multiply those together, and then we get our actual quantity times standard price. That's $4,515. Alright, let's do the standards. The standard, that information was also given. The standard is that it's 0.11 kilos per vest. Now there was 4,000 vests made, so to come up with what the standard quantity should have been, right? Because we know that if 4,000 vests were made, and we have an estimate of what we need per vest, well, so that's our standard, right? So we're going to multiply the actual quantity by the standard quantity, the standard per unit quantity, and we're going to come up with our standard quantity should have been, right? So we multiply that by the standard price, which is the $10.75. Well, we need to do a little bit of math first. So the 0.11 times the 4,000, that gets us to the 440 kilos. So the standard quantity to make 4,000 vests should have been 440 kilos. We multiply that by the standard price, which is $10.75. That gives us a total of $4,730. All right, what does all this mean? You do the math here. You subtract the 4,629 from the 4,515, and you get an unfavorable or a positive number. That's unfavorable of $100.14, and then you subtract the 4,515 from the 4,730, and you get a favorable 215. So what does that mean? Roundbelly experienced an unfavorable price variance because it paid 27 cents per kilo more for its styrofoam. That's why we went and we actually calculated the per kilo cost of the actual quantity and divided by the actual price to get that actual dollar value per kilo, so that we can, in our analysis, we can say, well, we know that we expected to pay $10.75, but we actually paid $11.02, so that's why it's unfavorable. We had an unfavorable price variance because we paid 27 cents more per kilo for the styrofoam. Alright, on the other side, Roundbelly experienced a favorable quantity variance because it produced 4,000 life vests using 20 kilos less than the standard expected. At 4,000 vests, we would have expected to use 440 kilos, but going back, we actually only used 420. So we used less to make the same amount than we originally estimated. Alright, that's the materials price. That's the materials variance. We had an unfavorable variance because we paid more, but on the other side we had a favorable variance because we used less. Alright, let's go to the labor variance. Also continue down on the green. We got HMS Roundbelly Inc. has the following direct labor standard for its life vest. It's 1.4 standard hours per vest at $20 an hour. Alright, last month employees actually worked 5,500 hours at a total labor cost of $120,000 and $250 to make the 4,000 vests, right? Okay, so we got continuity here. We got the same 4,000 vests, but now we're looking at the labor that went in to make those vests, all right? And so we're saying we got two things, or we got some given information. So let's plug it into the formulas and see what we come out with the variances. We got the 5,500 hours, right? That's the given. That's the actual hours that actual hours that were worked during the month. Okay. And then we say, well, what was the actual rate? Well, we do the math, and so we take the 120,250 divided by the 5,500 to come up with our actual per hour rate, and then we get that, and then, you do the math again, but you get back to the same answer of the total actual cost. The total actual cost was $120,250, but we see that the labor rate was $21. 86.36, and I added those extra 4 just for the rounding so that when we do the math it works. The 21.8636 per hour. All right, let's go to the actual quantity times the standard price. We get the 5,500 hours times the 20. That gets us 110,000. So if at that quantity we would have expected to pay 110,000. So it looks like we got an unfavorable variance because already we can see that we paid more. But anyway, let's go to the standard quantities and see what we're doing with the price variance on the labor hours. We got 1.4 hours, right? That's the standard. 1.4 hours is what we say it should take to make a vest, right? 1.4 direct labor hours. So 1.4 times the 4,000 is going to get us what we would have expected our total hours to have been, all right? Our standard hours. So we take the 5,600, which is the 1.4 times the 4,000, the 5,600 times the 20, which is also our standard rate. That's what we would expect to pay. And so we come up with what our standard said should have been for the total cost of labor, and it's 112,000. All right. So the difference between the 110 and the 112, we've got a favorable variance because at that quantity, at our standard rate, the $20, we would have expected to pay 112,000, but we actually well, hold on. No, on this side we're looking at the hours, and so let's read what we say here. It says Round Belly experienced an unfavorable variance, unfavorable price variance because it paid employees the $1.8636 more. All right, so we see that we have the unfavorable variance because our 21.8636 is greater than the 20. So we would have expected our expected rate was $20 per hour, but our actual cost, the actual cost that we paid was 21.8636 per hour. So we are just by that information we can see that we're going to have unfavorable price variance there. Now, Round Belly experienced a favorable quantity variance because it produced 4,000 vests using 100 hours less, all right, than the standard expected. So we would have expected to use 5,600 hours based on the standard, but we only used 5,500. All right. So as what it's looking like is we were using, and in this example, because we had probably higher rate of people, so probably more experienced, more expensive people, but they did it in less time, right? So they produced more within that expected time, but we paid them a little bit more. So we end up in an unfavorable position, but we can kind of see what happened. We paid more.